All right, so we return to the tag team of Nathan, the auditor, and Megan, the manager here, and they're going through the adjusting entries to correct misstatements, the uncorrected misstatements in some cases, from the prior year. Nathan's using this as a jumping off point for the discussion of this year's, which you'll be doing on your own in the practical exercise. So here's what we know. First off, Nathan covers the materiality that they used in the prior year. He states that the overall materiality was locked in at 2% of revenue, which was $24,000, and they set tolerable misstatement at 70% of that amount. That's $16,008. Now, he notes you can always use judgment to modify those materiality percentages. He notes that those percentages are established by firm guidelines and then can be modified based on subjective evidence. Now, you'll note here that they identify three particular misstatements broken out into the three categories that generally accepted auditing standards delineate: factual, projected, and judgmental. Now, two of the misstatements on this report related to accounts receivable. First, he says, well, when we performed our testing, we identified a $5,200 overstatement of AR and sales. Now, that's factual because there's no doubt about it. There's clear-cut evidence that that was a misstatement on that specific account, and so the proposed adjustment was a reduction in sales and a reduction in accounts receivable. They also had a projected misstatement of $19,525. Projected meaning it was based on the results of sampling projected to the population as a whole. That came from their AR confirmation procedures. Creative CPA Clothing said that they would post both of those entries. The final item, however, was a little different. They noted that there was a lawsuit outstanding, and so they had recorded a loss on litigation. However, the estimate that they originally had was $12,000, but the attorney in the case actually provided a range of $12,000 to $15,000, which would have made $12,000 correct, except the attorney went on to say that $14,000 is the likely best estimate. GAAS requires that when you are auditing and then you handle this amount, it's got to be for the best estimate of a point if there is one. You only go to the range if you cannot estimate a single point estimate as more accurate. So they should have accrued for $14,000, not $12,000, which is why we proposed a judgmental adjustment of $2,000. Again, it's a judgment call. The client felt that $12,000 was appropriate at the bottom end of the range. We felt that no, you really should accrue based on the most likely estimate. They ultimately did not post this adjustment, leaving that as an uncorrected misstatement, but at $2,000 ultimately did not impact the opinion given. A couple of other notes from Nathan here. One is that since they had originally assessed AR as a low-risk control area, since they did find the two misstatements, the one factual and then the projected misstatement, they reassessed and ultimately decided to raise the control risk over AR to high and tested some additional items as a result. Finally, Nathan wanted to mention that, these were not the only misstatements. There were others found, but they were below what's called the clearly trivial amount. In this case, they set that at 5% of materiality or $1,200. Anything below that amount is not material, whether taken individually or in the aggregate. Therefore, they didn't accumulate or mention those items to management beyond what he's telling her here that they did exist.